Welcome to the weekly market recap with Sampath Securities. Let's take a look at some of the latest developments in the Sri Lankan economy and financial market. Sri Lanka's construction sector has recorded strong growth according to the latest Purchasing Managers Index data for January 2026. The sector reported an index value of 75, marking its second highest reading on record. The highest level of 75.7 was recorded in July 2020 when the economy reopened after the first round of pandemic-related lockdowns. The latest reading indicates a sharp increase in construction activity. The total activity index also reached 75 in January, reflecting a significant expansion in project work across the sector. Even in December 2025, despite disruptions caused by floods earlier in the month, the index recorded a value of 67.1. This continued to signal expansion in the construction industry. According to the central bank, most of the firms reported higher project activity during the month. This was mainly driven by the commencement of new projects at the start of the year and the easing of weather-related disruptions experienced in December. However, the sector continues to face a major challenge. Many companies are struggling to recruit skilled employees for several occupational categories. Sri Lanka's industries are increasingly affected by a shortage of skilled labor, with the construction sector among the most impacted. The cost of living crisis in 2022 led many skilled workers to leave the country in search of employment opportunities overseas. As a result, labor costs increased sharply, pushing overall business costs higher and creating additional pressure on small and medium-sized businesses. Despite these challenges, the sector is expected to receive further support from government spending. The government has allocated 1.4 trillion rupees for public investments in 2026 under the budget 2026. This is the largest allocation made so far for public investment. In addition, construction work following flood-related damage is also expected to generate further activity in the construction sector. Overall, while the construction industry is experiencing strong growth, the persistent shortage of skilled labor could slow the sector's progress if the issue remains unresolved. Market participants remain confident about Sri Lanka's financial system in the short term. However, confidence over the medium term has weakened. This is according to the latest systematic risk survey released by the Central Bank of Sri Lanka for the first half of 2026. The survey shows that confidence over the next 12 months remain positive. However, expectations for the next 3 years have declined. The survey was conducted between 19 December 2025 and 16 January 2026 with the participation of 147 firms across the financial sector. According to the findings, the decline in medium-term confidence may be linked to uncertainties related to natural hazards and geopolitical tensions during the surveyed period. Respondents also indicated a higher perceived probability of a major negative event impacting the financial system. This increase was observed in both the short-term and medium-term outlook. The central bank also noted that perceptions of risk were widely spread across different areas. This indicates that there is no single dominant risk currently threatening the financial system. The survey assessed risk under the 7 major categories, covering a total of 46 sub-risks. These include global macroeconomic risks, fiscal and sovereign-related risks, general domestic macroeconomic risks, financial infrastructure risks, financial market risks, risk related to financial institutions, and general risks. The central bank also introduced a change in the risk classification framework starting from the second half of 2025. The previous category of domestic macroeconomic risks was divided into separate groups: fiscal and sovereign-related risks and general domestic macroeconomic risks. 3 new sub-risks were also added under these categories. The systematic risk survey has been conducted twice a week by the Macroprudential Surveillance Department since the first half of 2017. It is used to monitor how market participants perceive risks and confidence levels within the Sri Lankan financial systems. Participants in the survey included risk officers from licensed bank, licensed finance companies, a specialized leasing company, insurance companies, unit trust managing companies, margin providers and underwriters, stock brokerage firms, licensed microfinance companies, rating agencies, financial infrastructure providers, and mobile money service providers. The central bank also clarified that the survey results reflect the perception of respondents during the survey period and do not necessarily represent the views of the Central Bank of Sri Lanka. Sri Lanka recorded a notable decline in vehicles imports in January, according to a report released by the Central Bank of Sri Lanka. The report shows that the estimated cost of vehicle imports, including both personal and commercial vehicles, fell to $224 million in January. This marks a sharp decline compared to December 2025, when the vehicle imports were estimated around $301 million. The drop represents a decrease of about 25.58%. Meanwhile, the total value of vehicle imports for the full year 2025 was estimated at approximately $2.047 billion. Despite the decline in vehicle imports, Sri Lanka's external sector performance showed improvement. According to the report, the overall external trade balance recorded a significant surplus in January. According to the report, the overall external trade balance recorded a significant surplus in January. This follows an estimated surplus of $1.7 billion recorded in 2025. However, the report also noted a deterioration in the terms of trade compared to January 2025. This was mainly due to import prices rising at a faster pace than the export prices during the period. Sri Lanka's external sector has recorded a stronger than expected start to 2026, with several indicators pointing an improved foreign exchange position. According to the released data by the Central Bank of Sri Lanka, the external current account recorded a surplus of $369.7 million in January 2026. This marks a notable improvement compared to January 2025, when the surplus stood at $99.8 million. The latest performance also follows a provisional current account surplus of $1.7 billion recorded for the full year 2025. The merchandise trade deficit narrowed a year-on-year basis. This was mainly due to stronger export growth compared to imports. However, the reports note that the terms of trade deteriorated during the period. Import prices increased at a faster pace than export prices were compared with January 2025. Meanwhile, the service account surplus recorded a slight year-on-year decline. This was mainly because service outflows grew faster than inflows, driven largely by higher spending on overseas travel. Tourism continued to play an important role in generating foreign exchange. Tourist arrivals increased compared to the previous year, and earnings from the tourism were estimated at $378 million for January. Workers' remittances remained the largest source of foreign inflows. Remittances reached $751 million in January, reflecting 31.1% increase compared to the same period last year. This sustained growth in formal remittance channels has continued to support the secondary income account and reduce pressure on the overall balance of payments. On the financial account, foreign participation showed mixed trends. The government securities market recorded a net inflow of $17 million during the month. However, foreign investments in the Colombo Stock Exchange recorded a net outflow of $22 million, covering both primary and secondary market transactions. Meanwhile, gross official reserves stood at $6.8 billion at the end of January. This figure includes the swap facility with the People's Bank of China. The central bank also remained a net purchaser of foreign exchange in the domestic market during the month. In addition, the Sri Lankan rupee recorded a year-to-date appreciation of 0.2% against the US dollar by the end of February. Sri Lanka's national tea auction average declined in February 2026, mainly due to weaker prices in the medium and low-grown tea categories. According to data compiled by Forbes and Walker, the national tea sales average for February stood at 1,152 rupees and 11 cents per kilogram, equivalent to $3.72. This marks a decline of 12 rupees and 43 cents or 4 US cents compared with the January average of 1,164 rupees and 54 cents per kilogram. On a year-on-year basis, the February 2026 average was also lower. The price was down by 16 rupees and 82 cents and 24 US cents compared with the average of 1,168 rupees and 93 cents recorded in February 2025. The data indicate that export realization continued to face pressure amid currency movements and shifting demand across key export markets. A breakdown by elevation shows mixed performance across the different tea categories. High-grown teas recorded a positive trend during the month. Prices in this category increased by 15 rupees and 90 cents compared with January 2026. On a year-on-year basis as well, high-grown teas showed an increase of 53 rupees and 31 cents, reflecting continued demand and quality orthodox teas. However, medium-grown teas recorded a decline. Prices fell by 6 rupees and 3 cents compared with the previous month. Compared with February 2025, the medium-grown tea category reported a sharper drop of 46 rupees and 91 cents, indicating a weaker buying interest in the segment. Meanwhile, low-grown teas, which account for the largest share of Sri Lanka's tea production, recorded a steepest decline during the month. Prices in this category fell by 26 rupees and 38 cents compared with January. On a year-on-year basis, low-grown teas also declined by 30 rupees and 25 cents, reflecting continued pressure on this key segment of the industry. Sri Lanka's food inflation recorded a sharp slowdown in February 2026, according to the latest data compiled using the Colombo Consumer Price Index. The year-on-year inflation rate decelerated to 0.2% in February compared with 3.3% recorded in January. The year-on-year non-food inflation rate increased to 2.3% in February, up from 1.8% in January. On a month-on-month basis, the Colombo Consumer Price Index recorded a decline of 0.85% in February. The decrease was mainly driven by the food category, which contributed a negative 0.86 percentage points to the index. The decline in food prices was largely due to lower prices of vegetables during the month. Meanwhile, the non-food category made a marginal positive contribution of 0.01 percentage points. Core inflation, which reflects the underlying inflation trends in the economy, also eased slightly. Year-on-year core inflation decelerated to 2.1% in January compared with 2.3% recorded in January. According to inflation projections made at the monetary policy round in January, inflation is expected to gradually move towards the target level of 5% by the second half of 2026, supported by appropriate policy measures. Let's take a look at this week's Treasury Bill auction results. With the recent Treasury Bill auction, the 91-day T-bill rate stands at 7.63%, the 182-day T-bill rate stands at 7.92% at the same levels compared to the last week. The 1-year T-bill rate stands at 8.23%, down by 1 basis point compared to the previous week. Thank you for watching. We'll be back next week.